Got a question this week in the comments, which I love the comments. Please read the comments, gold in there. And I get a lot of my content from the comments, still reading every one of them. Let's get right into it. Basic question. Hey, Joe, if you're in a bear market where you're down at least 20%, would I retire? And a follow-up question to that is, hey, if the market was up 20%, would I retire a little earlier? Now, there's a lot to this, and I'm going to give an answer in how I think about it for me, okay? This is my story, how I think with my assets, my risk profile, one man's approach, okay? Now, hang on to the end of this. Many of you know that I just got back from about an 18-day trip to Alaska, land and sea, and I'm going to attach a video of a whale that we saw in Ketchikan. It's about 30 seconds, going to be at the very end. Okay, bonus material. Okay, so really, I look at this question as, would I rather retire when the market was up 20%, or would I rather retire when the market is down 20%? So first of all, a lot of assumptions in here, okay? And this is how I think about it. One, I need to know whether I have buckets or not, okay? This is buckets of money for short-term money that you need, maybe 0 to 3 years, first 3 years of expenses, and then maybe another 3 years for a longer-term bear market. So a total of 6 years that's not related to the stock market. So bucket one, maybe the first 3 years, that's your cash account that you live out of. Maybe it's in mostly in money market funds, CDs, treasuries, really fixed assets, fixed return. And then you maybe another 3 years in bonds. So you got 6 years that's not really related to the market going up and down. So you got some sort of bucket approach. Buckets buffer you against this drama right here. They buffer you against this drama. So let's assume for this question that I have 3 years in bucket one, CDs, money market fund, and another 3 years in bonds. And the balance in bucket three is in this stock market that has normal drama in it, okay? So I got buckets. I also like to use the 4% rule of thumb. It's not a rule. It's not a rule. It's a rule of thumb. Say, okay, does my withdrawal rate based on my total assets anywhere close to 4%? You know, I'm 5% may be good, 5.5% may be good, 3.5% may be good. I just want to make sure it's not 8, okay? The Dave Ramsey 8. I think that's of concern. So I want to do that. Also, I use a comprehensive software package called New Retirement. I can get a Monte Carlo score from that. It runs hundreds of simulations. I can see all the moving parts, like when I'm taking Social Security, my longevity, where my assets are invested. You know, how much is in Roth, how much is in traditional, tax management. So I buy New Retirement. It's $120 a year. There's a link to that below. I wouldn't make this decision without it. I'll just say that. The last thing you hear me say a lot is someone else reviews your plan, okay? You can't go this alone. You have errors in your plan. You gloss over them because it's your plan. You created it. I promise you there's going to be some errors, misunderstandings, and assumptions in your plan that aren't right, that another person, at a minimum, reviewing that has a higher probability of catching those. So those are my assumptions going into this question. So for example, if the market's up 20%, I still have bucket one at 3 years, bucket two at 3 years. So I got that 6-year buffer against that drama. Same thing on the way down. So my answer to this, if the market's up 20% and my buckets are full, would I retire a little bit earlier? Yes, if all this stuff matches up and I'm retiring to something, I got something exciting I want to do. Maybe it's travel, maybe it's camping, maybe it's taking care of a grandchild, maybe it's moving to a low-cost state, maybe it's starting a business, maybe it's starting a YouTube channel. Absolutely, would I seriously consider retiring a little bit earlier than my plan. Say my plan was 60 and I got my buckets full and I'm up, I'm doing well in the market. Maybe retire at 58 or 59 makes perfect sense to me. I would seriously consider that. And then down 20%. And this answer may surprise you a little bit, but again, my bucket's full, 4% rule, new retirement, someone else reviewed my plan. If the market's down 20%, that's actually a better time to retire than up 20%. And why is that? Well, if you look at the PE ratios, price to earning ratios of stocks, they're going to look more attractive to buy right here. This has a higher probability of going up than this one. Okay, so with the mark, now it's situational. It depends on if you're in a, the Great Depression. I'm just looking at averages and tendencies. This one will have the tendency to what's commonly known as reversion to the mean. Reversion to the mean is basically means that the stock market over time, this is before inflation's factored in, is going to be somewhere around 10%. Some of you may argue it's 9, some of you may argue it's 11, let's just say 10. It's going to revert to that long-term average over time. So if it's down 20% this year, yes, you can have some momentum pulling that down. There could be some market issues, economy issues pulling that down. But over time, it's going to, the pressure is going to be to revert to the mean. So the pressure on this one, this situation, is to go up. The pressure on this one is to come down. Yes, there is momentum here. You could get 20% this year, 20% next year, 30% the next year. Momentum is a real thing. It's a real factor in investments. But all things being equal, this is probably the preferred place to retire when the market's down a little bit, because I'm prepared with my buckets to handle another 6 years. Hopefully that makes a lot of sense to you. Definitely review your plan. Definitely review or have a new retirement, or if you're great at Excel, I still won't give you a pass on that. Excel is a separate thing in addition to a comprehensive package. I just wouldn't use Excel on its own. If you're looking for somebody to review your plan, the folks at Pickle, it's the second link below. Will free 45 minutes to talk to a certified financial planner that's been vetted. Give them a call if you think you got a great plan. No harm in calling these folks. Yes, the last 5 minutes they're going to talk about what's next, anything potential that's next for you, any arrangement you want to have with them. Maybe you want to do something plan only review. Maybe you want to sign up. You recognize, hey, maybe going full assets under management's the right thing, but please don't go alone. Get a comprehensive software package. Use the 4% rule and have some plan on how you're going to buffer yourself against the drama of the market. I use buckets. Again, hang on for this Alaska video from Ketchikan, Alaska last week.
Ring of bubbles is. He's going to come up with his mouth open.
Oh my gosh. That's amazing.
Yeah.